Good afternoon, everyone. Noel Vincent here, Managing Director at Senior Partners Private Wealth Management. Today is July 2nd, 2020, and it's about 7 p.m. Working a little late to get this message out to you before the holiday weekend. I'm joined by our Operations Director, Jeff Owens, and Jeff has a few housekeeping items to cover before we start the main content of the video. Jeff?
Thanks, Noel. We encourage you to watch this video update with a pen and paper handy just in case you want to take any notes. You can pause this video at any time by pressing the pause button in the bottom left corner of the screen indicated by the two vertical hash marks, or you can just click anywhere on the video image to stop and start. Replay the video as often as you like, and feel free to share it simply by forwarding the email message you received. Next, keep up to date with us by following our blog, forexlarge.com. Just visit our website at seniorpartners.net and click on blogs. You can also go directly to www.forexlarge.com. Just enter your email address and you'll get all of our video messages and market commentaries and the occasional articles we write related to your financial life. Next, we want you to know that we are healthy and here for you every market day. Financial services is one of the 16 critical infrastructure sectors identified by Homeland Security. We have been open throughout the COVID and we'd love to talk to you. Please call us at 281-440-9700 if you'd like to schedule a telephone call or an online meeting. I'll be back later to give you more information on scheduling appointments during the COVID. Now, today's topics will include an economic update, a due diligence report on alternative investments, changes to required minimum distributions, new tax filing deadlines, and scheduling online meetings. Noel?
Thanks, Jeff. Well, we want to give you a market update and commentary. Our view, our take on the current economic situation that we're facing. So I'll begin with the S&P 500 stock market index. The S&P 500 peaked earlier this year in late February, around 3,400 points. Then it dropped about 35%, that's about a third, over the next month, bottoming out in the 2,200 point range at the end of March. Now the index has since recovered about 90% of the initial losses it suffered when the COVID struck, but it's been hovering just above 3,000 since the end of May with no real trajectory. In addition, the market, we feel, is very expensive at present. As of this morning, the average share of stock on the S&P 500 was trading at 22.56 times profits earned over the prior 12-month period. 22.5 times earnings is an expensive stock market. Now, we have several concerns. Number one, to simplify the issues, the market's decline and recovery between February and March were largely based on fears of the potential economic impact of the COVID, followed by exuberance or overconfidence in the stimulus package and an unrealistic hope of reopening the nation and bringing the COVID under control. But neither the stock market's decline nor its recovery was grounded in actual corporate profit or loss reports from American businesses. It was just based on fears and hopes. Number two, the COVID did not begin to seriously impact businesses until the second quarter of the year, April through June. The first quarter of the year, January through March, was more or less business as usual, and corporate earnings reports, which come out quarterly for publicly traded companies, reflected only a slight decline in profits for the first quarter of the year. Number three, second quarter earnings reports for publicly traded companies will come out this month. As the reports are published, we'll have a much clearer view of how deeply American business has been impacted by the COVID. But I must say that we are expecting bad news. Number four, with an already overpriced stock market trading at 22.5 times earnings, a decline in earnings for the second quarter of the year, during which the COVID had its greatest negative economic impact on our economy so far, will drive the S&P 500's price-to-earnings ratio of 22.56 even higher, positioning the market, in our opinion, for yet another major potential correction. Number 5, since the nation tried to reopen and stimulate commerce in June, the COVID has come roaring back, as we all know. To date in the U.S., there have been more than 2.6 million confirmed cases of the coronavirus, and more, sadly, than 127,000 Americans have died of the disease. Last week alone reported a 38% increase in new cases over the prior week. Nearly 250,000 Americans were diagnosed with the disease in just the last 7 days. And number 6, unemployment continues to plague the nation. The Bureau of Labor Statistics just this morning reported an unemployment rate of 11.1%, which represents 17.8 million Americans being out of work right now. The economy is in a recession. Now, given the critical factors that I'll summarize that I just mentioned, A, the stock market being overbought and overpriced with a price-earnings ratio exceeding 22 times earnings. B, upcoming second quarter earnings reports expected to be much lower than first quarter reports. And C, the recent phased reopening of the nation's economy having resulted in both the resurgence of COVID cases and a partial reclosing of the economy. Again, we seriously doubt the U.S.'s economic engine is strong enough to withstand these challenges, sustain current stock prices, or drive the market up farther. In fact, we expect this current market to begin to decline. Now, based upon these current economic conditions, we are making the following general recommendations. These have been in place for a couple of months now, and we don't anticipate any immediate changes. So, number 1, we are still recommending bonds over stocks generally, especially for clients who want to be more conservative during the pandemic. Until we see how Q2 earnings reports affect the markets, and until we see a more permanent solution to the COVID, such as a vaccine or a broadly effective treatment. So to this point, we are holding more than $10 million in limited term bonds in brokerage accounts that we manage. Number 2, we're only using stocks in our separately managed accounts through Howard Capital. Howard uses mutual funds, exchange traded funds, ETFs, stocks, bonds, and cash, but on a tactical basis. This means that they track movements in the market with the use of an algorithm, that's a set of metrics and calculations, that dictates how much and when money should move in or out of the market as economic conditions change. So that's our position on the stock market. Now let's take a look at dividends and distributions and overall returns in the alternative sector under the coronavirus pandemic. With businesses closing across the nation, many temporarily under shutdowns, but some permanently going out of business, real estate investment trust income, that's rental income, has declined. Some borrowers in the private debt sector are having trouble meeting their debt service obligations. This affects BDCs, business development corporations. It also affects corporate mortgage funds. And then private equity investments are seeing drops in revenues, just generally because of the decline in the economy and also because of specific sector issues. So in the past few weeks, we've held conferences with senior executives of a number of our non-traded direct investments. Each has expressed a similar sentiment, that being that direct investments will continue to lag as all other investments will under this economy as the economy suffers through the COVID crisis. We're receiving reports weekly, in fact, on real estate trusts, business development corporations, and other direct participation plans that they are cutting their dividends and that they are closing their share redemption programs temporarily. This, of course, will compress income for many investors who rely in part on these distributions. So if you need to make some adjustments in your income plan, if you're feeling things are getting tight and we need to look at some other options, in light of these economic changes, or if you just want to review your portfolio or your financial plans or talk about any new issues, please call the office and schedule a telephone call or a video conference so we can help you. Advice and planning are our bread and butter. That's what we're here for. That's what we do for you, and we're here for you. So please call and let's get something scheduled. And in the meantime, We hope and pray that you'll remain healthy and safe through the holiday weekend. Jeff?
Thanks, Noel. In our last video message, I mentioned a possible change in the RMD rules for 2020. We have now confirmed that the CARES Act stimulus package has eliminated RMDs for this year, 2020. If you're receiving automatic RMD distributions and don't want them this year, please call us ASAP. Since RMDs are not required this year, we will not contact you to calculate your RMD and send it out. Some clients rely on their RMDs for living expenses, property taxes, etc. If you need funds, let us know. If RMDs are reinstated next year for 2021, we will contact you to help you make withdrawals. Remember that the age for starting RMD withdrawals was recently moved back from age 70 and a half to age 72. This was a permanent law change. On to tax returns. Aaron Keys and his team are working hard on tax returns and wrapping up the tax season. Please get your documents in as soon as you can. The tax filing deadline was moved back from April 15th to July 15th, which is less than 2 weeks away. Please don't wait till the last minute to get your documents to us. If you rush to complete your documents, you might miss something. A return prepared in a rush may contain errors. If your return is delayed because documents arrive too late, we might have to file an extension for you. The extension deadline is still October 15th. Since the outbreak of the pandemic, we have moved all client appointments to telephone and video conferencing. While phone calls are normally sufficient to take care of your needs and get things done for you, video conferences can really improve the experience. We're holding many video conference meetings with clients now, and clients are finding the process easier than they might have expected. There are a number of technology options today, including FaceTime for iPad and iPhone and iPad users, Skype and Zoom are also good options for desktop, laptop, and smartphone users. We realize some of these technologies may seem out of reach for some clients, but we can help you set up your computer, smartphone, or device to work with these options. Just call the office and we will walk you through the simple steps to set up your devices to meet with us online. It may be easier than you think, but phone calls are always available too. Thank you for watching this video message. We look forward to meeting with you soon. We hope that everyone has a safe and happy 4th of July holiday.